Andrea starts us off with, hello, Mike. If possible, could you take a look at this position? I was assigned early at 61.92 on MRVL. The stock dropped and I'm currently suffering a loss of about $535. Through the stock repair tool, I opened a ratio call spread. Okay, so the first thing, let's do this. Let's see what the ratio spread might be. She has specific numbers that she has a question about. We're going to go through that in a moment. But we'll pause for a moment and discuss quickly the stock repair. I had this discussion on this last week, 2 weeks ago, I believe. But what the stock repair tool allows you to do, I'll just put in my symbol here, and I'll click on stock repair in the right-hand corner. It allows us to put in our original cost per share, and Andrea said at the time it was 61.92 was her cost basis for the position roughly. And we have 100 shares of stock just to keep it simple. Now, what this tool did is it went out quickly across the market for this particular stock, and it tried to build ratio call spreads to help get a better break even. Remember, the original purchase price was 61.92. The stock's trading at 57.09, so it's a little bit better now. It's going to relate to Andrea's question. But this adjustment allows us to get a break even of only 58.87 in just a couple of weeks out in time. And it built a ratio spread by looking at a buy strike of 57 and a sell strike of 59 for a net credit of $1.18. The cost basis was 61.92. So with $1.18, that would only drop the break even down to $60 and roughly 74 cents. How are we seeing a break even of 58.87? When we click on the repair details, it gives us a breakdown of the repair itself. Against 100 shares, we're going to do a ratio call spread. We're going to buy one Marvel 57 call at 320 and sell two Marvel 59 calls at 219, which will bring in $438 total, with paying out $320 for the one bought call at 57. So that generates the net credit of $118. But as I mentioned, on the cost basis of 61.92, we'd only be looking at a break even of 60.74, wouldn't we? How is the break even at 58.87? Well, remember, we bought a 57 strike call and sold two 59s to achieve that net credit. We essentially own that 57 call at a discount. So what happens if the stock's trading at 58.87? Against our cost basis of 61.92, we have a total loss of $305. We took in the $1.18 net credit right up front for the ratio call spread, but that 57 strike call on the 25th of August with a stock at 58.87 is going to have $1.87 worth of intrinsic value. The two short calls expire. We sell to close the long call for 187, keep the 118 net credit, sell the stock at 58.87, and we're at our cost basis of 61.92. It's great to see things numerically, but when we're evaluating a potential rollout opportunity, if you click on Analyze Trade, that'll take you directly to the profit and loss chart where we bought shares of stock at 61.92, bought one 57 call at 320, sold two 59 calls at 219 to complete the ratio repair position. And that gave us the net credit, of course. And down below here we see that break-even price now at 58.87 on August 25th expiration. And if the stock goes above 59, we'd make a profit of $26 or 0.4%. Not extraordinarily high, I understand, but it's better than still looking right now at 58.87, a loss on our position of about $3 and about 15 cents from the cost basis of 692. So turning a loss into the profit with the stock repair. Now we're entering a ratio call spread, which by itself is usually a no-no because one of these two calls would be naked, which would be infinite risk to the upside. But in the structure of owning stock, essentially what we're doing is a covered call with our 100 shares that were put to us at 61.92, selling a 59 strike call against it for 219, and doing a bull call debit spread at the same time, buying our 57 call at 320 and selling a 59 at 219. So everything is covered. It does have a capped gain, as we saw, because essentially the one short call is obligating us to deliver our 100 shares of stock at 59, and the other short 59 call is covered by that 57 call, so we can get the $2 back in between. That's why you see this ramped up return, this ramped up profit between 57 and 59 before the capped gain hits in. But Andrea's position is slightly different. When she looked at the repair, she bought a 57 for August 25th at 309 and 59 at 215. Very close prices. So let's put those in. 309. I didn't read this part first, but it was the same repair. It was the closest repair. So Andrea took the nearest one closer in. But what she did at the time was it was cost of 309 for her August 25th 57 call and $2.15 in this case for the 59 calls. This is a net credit of $1.21. So 430 taken in for selling the two contracts of the 59 call at 215. Paying 309 out against it. This does lower the cost to $60.71, a little bit better, Andrea, than what we were seeing with the repair today. So that is how the break-even dropped to 58.86 in Andrea's case, because the stock's trading at 58.86. She's going to keep the $1.21 net credit, the 57 strike call here at 309 that was essentially paid for, that she owns for free, is going to be worth 186. So essentially just from that, the net credit and value, intrinsic value, not implied volatility, but intrinsic value of that long call of 186, that's going to put us at a total value of 307 plus the stock price at 58.86 at expiration, the break even, puts us right back to that cost basis. Sorry for that, 61, looks like 93 in this case. We're at break even to 58.86, the value that we originally paid for the position. Similar to what we saw, Andrea, in the first example that I used straight from the stock repair to illustrate how that worked. If the stock moves above your 59 strike call, sorry about that, let's erase those drawings here and move down a little bit. There we go. If the stock moves above 59 and you do nothing, you would be assigned 100 shares of stock at 59. You could close out the bull call debit spread for the 2 points, or your broker would do it for you, Andrea. Essentially, buying 100 shares at 57, selling them at 59, you'd get the $2 back. You get assigned at 59. And so you say, oh, well, I'm only taking in $61. My cost basis was $60.92. What am I forgetting? How am I making a profit in this scenario? Because right off the bat, you also took in that net credit of 121. So your total value at assignment, if you did nothing and the stock was above 59, assigned your 100 shares of stock, automatically exercise and assign, your broker would do that, the bull call debit spread, you'd have a total value of 62.21, including the net credit, minus that 61.92, 61.93 purchase price. There's your profit of the 29 cents, or 0.5%. What happens if the stock, as I mentioned before, is just at break even at 58.86? Your short calls will be expiring worthless, or you could buy them back for maybe 2 or 3 cents. This would have $1.86 of intrinsic value. You could sell to close the long call and sell to close the stock. Minus commission costs, you'd be pretty close to break even. If the stock here at 57.09, if the stock continues to fall in price, what is the one thing or what is one thing that the stock repair tool doesn't do for you? The stock repair tool does not hedge the downside. So you did collect a $1.21 net credit, which lowered your cost basis immediately from $61.92 down to $60.71. However, if the stock continues down to 56, 55, 54, 53, you're still taking losses to the downside. You may want to consider closing out the current repair, if you can buy it back cheaply, and evaluating a new repair based on your new cost basis. But if the stock continues to fall, you may just want to set a bottom for yourself, get out of the position without allowing the loss to go beyond, say, 9, 10% in that case. Or look to buy a put option if it's still declining in price to help hedge any further losses, then reevaluate the situation later down the road. What if you don't want to lose shares of Marvel? You want to continue with your shares of MRVL going forward in the market. But in the next 2 weeks to August 25th, Marvel goes up to, say, 59.50 up here. How would you manage the position? Well, think about it in the simplest terms. We have a bull call debit spread with that 57.59 strike. This is going to give us $2 back. We want that. We're okay with that. We're okay with the one contract bought at 57, one contract sold at 59. The stock goes up to 59.50, 60, Andrea. Well, we're going to allow that to stay in place, or we'll close out the bull call debit spread manually on or around the August 25th expiration. It's in the money for close to that $2 back. And I have one covered call. My other remaining sold call is just against 100 shares. So what can I do with that? The same thing that you would treat any covered call that's now in the money that you want to continue long term. You'd consider rolling the call up in price and further out in time to look for a credit. And of course, we can use the portfolio tools to track just that covered call portion to evaluate which rollout opportunities might be the best to roll for a credit in this scenario based on what your expectation for the stock is. And of course, any further upside profit targets that you have for Marvel now that it's recovered, gotten you back to break even, but you want to continue the trade as well. And if the stock is between, so I think we did talk about that. I just covered that. Andrea commented and says, all clear, thank you. What happens if the stock is between 57 and 59 or drops under 57? If you let it go to expiration, now here's a trick that you probably want to avoid. And I know you probably recognize, Andrea, you probably sent that before I wrapped up on that one. Stock's here at 58. What's happening as we get closer to expiration? These calls are getting ready to expire worthless. They're out of the money. You can buy them back cheap for that 1 or 2 cents, maybe 3 or 4 cents, depending on implied volatility. This call, the 57 call, is in the money. Now, what I mentioned a few moments ago about what happens if the stock is between the strike prices or even at the break even, these calls are going to expire worthless, and I mentioned you want to sell to close this call. And you can get the intrinsic value or maybe a little bit more back from it. You know, if it's trading right at 58, we get $1 or so back from that call. Not timing, but more the operation, Andrea, is important in this case. Remember, I have 2 sold calls, 100 shares of stock, and sort of a long call here. So I have a bull call, debit spread, and a covered call. If I sell to close the long call first, now this second short call is going to be a naked call that has infinite risk to the upside, and your broker might go confusing with the margin for that short period of time. Order of operation, close the short calls first, one or both of them, then sell to close the long, and you still have your 100 shares of stock. You got the $1.21 net credit. Let's say you paid 10 cents to buy back the 2 short calls at 5 cents, and you got another $1 for the 57 call. So where would we be? Well, $1.21 minus 10, that's going to put us at $1.11. That's the initial net credit, remember. 10 cents to buy to close the calls toward right around 4 o'clock on August 25th. Stock's trading at 58. Sell to close that 57 call for $1. So we get $2.10. And we had a cost basis of $61.92. So our cost basis is going to drop down to $59.82. Not too bad. Shares of stock, cost basis now $59.82 on a stock trading at 58. That's not too bad. Come Monday morning, I can look at the stock repair again, or maybe I can just sell an out of the money 59 call for another 2 weeks out to get that remaining $1.80 or so that I'm missing, or not really. If I sell it for 59, I apologize. I need 82 cents if it moves up and gets a sign, but I'm probably going to get $1.10, $1.20, $1.50. If the stock does trade below 50, if it drops down to 55, what happens? Both calls expire worthless. You're long 57, you're too short 59s. Again, you keep your $1.21 net credit. In that case, cost basis would be $60.71 on a stock trading at 55. So you're down about $5.71 in this case now. The net credit was yours to keep. And again, follow up with evaluating another potential stock repair based on where the stock currently is trading. The options are with a new cost basis of $60.71 with the stock trading at 55. Protect or hedge the position if you're concerned about further downside, or maybe exit the position and look for something else. The loss would still be that $5 or so, $5.71. Probably close to, 8.2% loss on the position, something along those lines. So that downside is still open for further loss. And that's what you have to look out for. So those are the scenarios. If it's trading above, hey, you'll get out with a $29 profit by doing nothing. Broker will assign the 100 shares, close out the bull call debit spread. At 58.86, you've got a profit on the position, even though your cost basis was 60.71 and 61.92 to start before the repair. Not too shabby. Stocks at break even, your two short calls expire worthless, or you buy them back cheaply is a more accurate way to say it. And then you sell to close the long. What happens if you don't do that? What happens if you just left the whole thing open? The stock's at 57.09, or it's at break even. I apologize. Just stay there, Andrea, at 58.86. Your short calls expire worthless, and you've got a 57 strike call open. Your broker would assume you wanted to buy another 100 shares of stock at 57 if you didn't close out that long leg. But come Monday morning, stock's at 58.86. You own 100 shares at 60.71. You would have purchased another 100 shares at 57, which means now you have 200 shares with a total cost basis of 58.85. It works out the same. Closing out the bull call debit spread, allowing assignment, works the same effectively as doing nothing in this case at break even, having the short calls expire, allowing your one long call, remember that you were paid to own, be exercised to essentially average down to 58.85. That would be the same thing would happen at 58 if you did not sell to close the long call. But order of operations, in order to sell to close the long call to get that intrinsic value, you want to make sure you buy to close the two shorts first for some value, 5 cents a piece, maybe $10 total, something along those lines. Might affect this break even a little bit, and then the commission costs factor in as well. So you want to keep that in mind. You don't want to sell this first, because then momentarily you would have a naked call and your broker might raise an alarm that you have a high margin or anything along those lines as well. Okay. All right. So that's the stock repair tool. That's what it's looking to do, is to build that ratio spread. You know, if we had 200 shares, we see a ratio repair of buying 2 contracts at 57 and selling 4. Still the same thing. We'd have a covered call against 200 shares technically with a bull call debit spread of 2 contracts apiece. The break even would be the same. The monetary values would be the same, just at a higher order. All right. So I hope that's clear, Andrea. And it's a great topic to cover. As I mentioned, let me close this window here first. There we go. Those repair details. Remember that 2 ways to access it. Right on the main page, just enter in your symbol and then click on the stock repair tool, or you can go into the signature tools tab here and click on stock repair as well. First things first, going back to MRVL. And did I leave it up? I did not. Okay, that's fine though. I remember most of the values are close to it. Oh, I do have it here. Great. We're just going to go back to our analysis of Marvel for 2 things. And the prices were different, Andrea. We're staying here. One thing I want to say, I saw the prices of Marvel for next week's expiration, and then I'm seeing the prices here that still exist for this one today. A stock research tool this time. That's what I wanted to warn you about. That came up to mind when I saw the price discrepancy for next week's August 18th, 57, 58, and 59 calls compared to what the prices are for the August 25th. It told me, without even looking here, that the earnings for MRVL were likely going to be the 24th. So that's a consideration here going in to your Marvel position and what we talked about with repair. I know these numbers are slightly different than yours. Break even at 58.87. We were looking at 58.86. Come the 24th, Andrea, you're going to run into 2 slight problems. Number one, these options are still going to be very highly priced. I had mentioned that as you get closer to expiration, the stocks between the strike, oh, you're going to be able to buy this back for 5 or 10 cents. Not on the 23rd, you're not, unfortunately, and not on the 24th likely, because that earnings is going to keep the IV really high, even though they have 1 day to expiration. So those are going to be really enriched with the known event, with the unknown outcome coming up in 24 or 12 hours. So this repair is going to be difficult to close out early because of the inflated implied volatility that's going to be in the options on the 23rd and on the 24th. Even now, I saw that just looking at the chain with the prices of these strikes compared to that numbers we looked at for that last discussion for the 18th. There's a big discrepancy for just 7 days, and that's due to the 18th expiration is not going to be affected by the earnings for MRVL. The 25th are going to be the most impacted by this, and everything slightly after it. So if you can get out with a reasonable profit, you can get out close to break even at that, you might want to consider it. But again, what does this repair not do? Other than that $1.21 net credit you took in, Andrea, it does not protect against the downside anymore beyond that. If you're going to hold this position through earnings, you might want to consider looking for a cheap put. Maybe not for the 18th expiration, maybe going out to September where implied volatility might not be as too high, but it's still going to be inflated because it's going to be affected by the earnings of it. But something that could give you a little hedge here or a little floor going through earnings, because as I mentioned, this only protects you here. If this has a 25% drop at earnings and it drops down to, 49 or 47, you're still looking at a bigger loss. And that earnings is coming out on the 24th, as I mentioned, day before the expiration of your stock repair we were talking about, and is after market. So after the market close. So even on the 24th, those positions are going to be fairly inflated. Those options are going to be fairly inflated. So, Andrea, we'll talk about that later because we're already at 5:32. But you said you didn't check help. It's not a bad thing. You're going to see price fluctuations on that. We can look at that next week as well, because we've got a full week to go before the 24th or the 25th. Doesn't mean you're in a bad position at all. Okay. There's some things we might want to consider in this scenario. We'll take a look at that a little bit later on. Not today, but we'll take a look at that. You've got time. No worry about it right now. You've got another 2 weeks to go before that 24th earnings and before the expiration on the 25th. You're not in a bad position by any stretch of the imagination right now. And you said I'll buy a put. Well, I don't want you necessarily to think about buying a put yet. We'll show why and just now. I'll leave that for a separate discussion. But remember, if you buy a put now, it's going to change the whole dynamic of your existing trade. You're taking away from that $1.21 net credit. So that break even that you had with the stock repair is going to be different. You might not even have a profit to the upside if the put costs you more than $1.21. It'll be less of a loss than owning the stock, but that capped gain to the upside might be in the negative range. Okay, I'm here. And I'm going to do that real quick. Okay. Oh, 25th. See, I don't want to go above $1.20. So if I buy, like, say, the 51 or the 50 strike put, that's over a 10% decline. So I don't know if that'll help. But if I just bought the 52 put, same expiration, we're just buying one, but it's going to cost us about $1.10, $1.08. So what is that doing? Remember, the initial net credit you took in was $1.21. So now you're only taking in 31 cents. The break even doesn't exist because the best case scenario now, if it goes above 59, is a loss of 1.3%. Just by how it changed the structure. The max risk is still 15.9% if the stock drops below 52. Okay. That's because it's a highly inflated price. I'm going, several strikes out of the money, 5 or 6 strikes out of the money here. Yeah, so there's no break even because you can't win on this position. Is a 1.3 loss better than what you would have had if you sold the stock when it dropped down to 57 from your cost base of 61.92? Absolutely. That's absolutely true. But this isn't getting you to a profit that you want. That's where it gets kind of tricky.